There's a tension running quietly through corporate America right now. It doesn't always show up in headlines, it's rarely stated directly on earnings calls, and executives almost never frame it this way in public. But inside boardrooms, strategy sessions, and capital allocation meetings, it's there. The new business fear no one is saying out loud is this: what if demand looks stable on the surface, but is structurally weaker underneath? For years, companies knew how to navigate visible threats. Inflation was obvious, rising interest rates were measurable, supply chain disruptions were tangible. Those risks could be discussed openly and modeled. But today, a more subtle anxiety is shaping decisions. It's not about a dramatic collapse. It's about quiet fragility. It's about the possibility that consumer strength, enterprise spending, and overall growth are more dependent on temporary factors than leaders want to admit. This fear isn't dramatic, it's strategic. On paper, many businesses are still reporting decent revenues. Employment levels remain relatively strong. Corporate earnings haven't collapsed. Yet underneath those numbers, there's caution. CFOs are modeling slower order flows. Sales teams are reporting longer deal cycles. Customers are committing later and negotiating harder. No one wants to say demand is fragile, but many companies are acting as if it might be. You can see it in capital spending. Firms are delaying large, irreversible investments. Instead of building full-scale capacity, they're expanding in phases. Instead of aggressive hiring, they're relying on productivity tools and automation. Expansion plans include more exit ramps. If executives were fully confident in long-term demand strength, these decisions would look different. Another sign of this quiet fear is the obsession with guidance control. In previous cycles, companies were willing to project ambitious growth targets. Missing them carried consequences, but upside was rewarded. Today, guidance is conservative. Expectations are managed tightly. Markets are punishing uncertainty more than modest performance, and companies know it. This environment has created a subtle shift in corporate psychology. Leaders are less afraid of slow growth than they are of sudden deceleration. The real fear isn't that growth is moderate, it's that growth could evaporate faster than models predict. Consumer behavior contributes to this anxiety. Spending patterns have become unpredictable. Households respond quickly to changes in interest rates, inflation, and job market sentiment. Subscription cancellations rise faster than they used to. Big-ticket purchases are delayed at the first hint of uncertainty. From the outside, demand may look steady, but inside companies, forecasting feels harder than ever. Enterprise spending tells a similar story. Large contracts are taking longer to close. Budgets are approved, then paused, then reapproved. Procurement departments are scrutinizing costs more closely. Even profitable companies are cautious. This suggests something deeper than cyclical slowdown. It suggests hesitation, and hesitation spreads. When one company delays spending, it becomes another company's revenue shortfall. That shortfall then influences hiring, investment, and procurement decisions elsewhere. The economy becomes more sensitive to shifts in sentiment. This is the quiet fear, that confidence itself is thinner than it appears. Technology is adding another layer of complexity. Artificial intelligence is reshaping industries rapidly. Some businesses are investing aggressively to stay competitive. Others are uncertain about return on investment. No one wants to fall behind, but no one wants to overspend on tools that may not deliver immediate payoff. So companies move carefully, they experiment, they pilot, they measure. That caution reflects underlying uncertainty about where sustainable value will emerge. Financial markets amplify this dynamic. Investors are rewarding predictability. Companies with stable margins and strong cash flow are often valued more highly than firms chasing rapid but volatile growth. Missing forecasts leads to sharp stock price reactions. Executives see this and adjust behavior. They emphasize durability over expansion. They talk about resilience, efficiency, and discipline. But beneath that disciplined language is a shared understanding. Volatility could return quickly. Another dimension of this fear is structural change in consumer and corporate balance sheets. Years of stimulus, low rates, and liquidity created unusual strength. As those conditions normalize, the question becomes whether demand remains organically strong or whether it was temporarily supported. No CEO wants to openly question the sustainability of their own revenue base, but strategic planning reflects the possibility. That's why flexibility is prized. That's why liquidity buffers remain high. That's why hiring is measured. That's why capital committees are more conservative. This isn't panic, it's guarded optimism. Even labor markets reflect this shift. Companies are reluctant to expand headcount aggressively unless demand visibility improves. They invest in automation and productivity improvements instead. They protect margins carefully. The fear isn't collapse, it's overextension. Overextension in a fragile demand environment can be fatal. High fixed costs, heavy debt, and large expansion bets become dangerous if revenue softens unexpectedly. So businesses build shock absorbers. They diversify revenue streams. They strengthen balance sheets. They structure contracts with more flexibility. Publicly, leaders emphasize confidence. Privately, they stress test downside scenarios. Geopolitical uncertainty reinforces this mindset. Trade tensions, regulatory changes, and global conflicts can influence supply chains and consumer sentiment rapidly. Companies factor these variables into planning more aggressively than before. The result is a corporate landscape that looks stable on the surface but is deeply cautious underneath. The new business fear no one is saying out loud is not about recession headlines or dramatic crashes. It's about the possibility that the foundation of demand is less solid than it appears, that beneath stable metrics lies sensitivity to shifts in rates, credit conditions, or sentiment. And because this fear is subtle, it shapes behavior quietly. Companies move slower, they expand carefully, they commit capital incrementally, they avoid bold promises, they preserve optionality. In some ways, this caution is healthy. It reduces systemic risk, it encourages disciplined management, it strengthens balance sheets, but it also changes the tone of business strategy. Ambition is filtered through risk control. Growth is pursued with contingency plans attached. The companies that succeed in this environment will not necessarily be the most aggressive. They will be the most aware of fragility, aware of leverage, aware of sentiment. Because the biggest risks in today's market are not always the loudest ones. They are the quiet shifts in confidence that ripple outward before anyone names them. And until that underlying confidence feels unquestionably durable again, this unspoken fear will continue to shape corporate behavior, not through dramatic announcements, but through cautious decisions made every single day.